name is Brandon Gerken. I'm the SBA lending manager here at State Bank, and I've been here for a little over 11 years now. I essentially oversee our SBA lending program here at the bank. It's a business loan that comes from us, the bank, and it's backed by the United States government. And essentially allows us to give access to capital to borrowers who otherwise would not qualify for a conventional business loan. You would need to qualify and apply for to be an SBA lender with the U.S. government and with the Small Business Administration, which we've done. We actually have our preferred lender license with the SBA, which allows us to partner with the SBA and do things on a delegated basis. For us, there's multiple benefits. There's benefits for us as a bank, but there's benefits for the borrower as well. You know, for us, in case in point, over the last several years, we've now done close to, I think, right around 90 million in SBA loans. So we're approaching that 100 million mark, which is great. And that's absent from the PPP loans that were done back in 2020 and 2021. So for us, it's a benefit because it allows us to do some loans that we otherwise wouldn't been able to do and provide that access to capital. The benefit to the borrower in this particular case is now they're getting the financing they need to run their business, expand it, perhaps hire new employees and so forth. We as a bank, we typically always look at every business loan initially as a conventional loan. If it would not qualify and meet those conventional standards, then we go down the road of looking at it from an SBA perspective. So for us, some of those characteristics might be that there's just not enough collateral there on the loan. It might be a startup. It could potentially be in an industry that has inherently higher risk. They could potentially have uneven earnings performances. And the one that we actually use it a lot for is for business acquisitions. That plays into the collateral piece a little bit, but I would tell you approximately 50 to 60% of the loans that we do are business acquisition loans. They come with some blue sky there and some goodwill that's built into that purchase price. And the SBA program not having or that loan not having the collateral built into it allows us through the SBA to do that. It really starts with the loan application up front, or the loan package, if you will, which is essentially financial information. So it depends a little bit whether it's an existing business or a startup, but the typical information that an individual is going to have to provide is their 3 years of their personal tax returns and a personal financial statement. And then on the business side, if it's an existing business, they would provide us with the last 3 years of business tax returns, their interim financial statements, which includes a profit and loss statement and balance sheet that's current and most recent. And then lastly is the debt schedule to give us a listing of their any existing debts that they have. Now, transitioning a little bit, if it's a startup or somebody who's purchasing another business, not only would we need the individual financial piece of information that I mentioned before, but we're also going to need some other pieces also. We'll need the tax returns for the business that's being purchased if there's an acquisition in play. And if it's a startup, then we're going to need something more, a little bit more in depth with a business plan and projections to go along with that. Some common errors that we probably see borrowers make, if it's an existing business, maybe some inaccuracies or incompleteness with the financial information that they provide us. So that's one thing I think that I would love to see borrowers do a little bit more is make sure that they double check their information before they give it to us. On the flip side of that, for startups and for those looking for business acquisitions, it's really about thinking through their entire situation. Make sure they've thoroughly researched it, that they have thought about what their needs are, what they're trying to accomplish, and being able to articulate that and being clear and concise with what they're trying to do. So I think being able to provide that information to us and give us that clear picture up front is really key. And those that can do it well initially, those are the ones that tend to see a little bit more success. Best piece of advice I could probably give somebody for a business loan in the future would be surrounding themselves, I think, with a good business team, a group of advisors, if you will. Particularly for somebody starting up their own business. That business owner, I should say, is going to want to get a good accountant or CPA on their team. An attorney would be another great piece of that team. And then certainly their banker, their lender, in terms of financial and banking advice that they can give them. And lastly, is really a mentor. Somebody who might already be in that industry, somebody that they can lean on and take advice from as they move forward and build their business.